If the dollar really does lose its global dominance, the average American isn't just facing headlines. They're facing higher grocery bills, more expensive iPhones, and potentially climbing interest on debt. Think of it as inflation's sneaky little sibling that doesn't leave. You've probably heard whispers that China is accelerating plans to push the yuan onto the global stage, but you may not realize how quickly some countries are actually switching their trade agreements. So how close are we to Ray Dalio's timeline for the dollar's fall? And when will it hit your pocket directly? Why headlines about the dollar suddenly got louder? In early 2025, the headlines about the dollar's position in the global system started showing up not only in financial newspapers, but also in everyday outlets. Suddenly, news anchors who usually save time for sports or celebrity gossip were running stories about currencies, central banks, and reserve holdings. What changed is that the subject no longer looked like an academic debate hidden in research papers. It became a practical issue that economists now link directly to how much households pay at the store and at the gas station. The shift is striking because for years, currency dominance was considered a background condition of the global economy, something reliable and barely worth mentioning in daily news. But the volume and tone of coverage in 2025 signals a break from that comfort. The explanation lies in the growing number of trade deals that exclude the dollar outright. When nations reroute their settlements into other currencies, they set the stage for practical consequences. These agreements, once scattered or symbolic, have now reached enough scale to carry weight. 10 years ago, a trade deal between two mid-sized economies choosing to settle in non-dollar denominations might have been filed away as diplomatic theater. Now, the accumulation of these agreements is substantial enough to matter. Each one may look modest, but together they slowly erode the role of the dollar as the default settlement tool. This is the reason mainstream networks, not just financial publications, are carrying the story with more urgency. Currency news usually felt far away because of its technical nature. A household buying groceries or paying rent rarely thinks about World Bank data or reserve ratios. Yet economists point out that the chain from foreign exchange markets to consumer prices is more direct than many assume. A currency losing ground affects borrowing costs, which influence the interest rates for mortgages, credit cards, and government debt. That, in turn, shapes inflation trends. When inflation stays elevated, prices for imported goods become even more sensitive to exchange rate changes. In 2025, with living costs already high from years of economic uncertainty, people no longer dismiss this as abstract. They feel it at the cash register. Newsrooms picked up on this connection and began framing stories about the dollar with a household angle, which gave the topic broader reach. What used to be considered an academic conversation about global reserve status has entered the realm of policy action. Governments are no longer just debating the merits of de-dollarization in think tank circles. They are signing agreements and announcing frameworks that shift real flows of money. That transformation signals why headlines grew louder. The topic jumped from being intellectual speculation to being demonstrated in practice. Policymakers in different regions, often frustrated with how exposed they feel to decisions in Washington, are actively designing workarounds. Even if some experiments remain limited, their existence changes the perception that the system cannot be altered. Once a precedent is established, more countries feel encouraged to consider their own alternatives. The consequence is that discussions about reserve currencies no longer attract only historians or monetary scholars. Businesses are paying attention too. Corporations with supply chains spread across continents are calculating whether an erosion of dollar convenience would affect transaction costs. Energy companies are monitoring whether more clients request settlements in other currencies. Banks are adjusting their strategies to include hedges that account for subtle shifts away from the dollar. All of these developments then spill into news coverage, creating attention far beyond what the subject once commanded. Another reason the conversation tightened in 2025 is that the timeline of change has become visible. For years, critics claimed that global reserve structures move at such a glacial pace that no current generation needs to worry about them. But recent years show adjustments happening quicker than expected when compounded together. The dollar's share of reserves has not collapsed, but it has contracted enough to break prior forecasts. These changes push analysts to renew projections, and those revisions give journalists new leads to cover. The story is no longer about predictions made decades in advance. but about ongoing moves unfolding right now that set up the trajectory of the next decade. Consider how much of this debate once stayed confined to conferences and closed-door discussions. Academics would present data, policy think tanks would publish reports, and the broader public would hear nothing. In 2025, however, signs of change appear tangible enough for the public to recognize. The sudden consistency of coverage reflects the fact that a threshold has been crossed. This is not speculation to file away, but a turning point visible in real markets and policy announcements. That is why headlines feature words such as decline, erosion, or replacement rather than simply discussion. The tension lies in how the story was framed before. For years, advocates for de-dollarization were dismissed as fringe voices insisting on unlikely change. Economists at mainstream institutions would often call the dollar's dominance unshakable. The contrast now is that those same institutions publicly note the shifts with seriousness. The academic margins have moved into mainstream acknowledgement. That change in tone is what audiences pick up. They no longer hear about this only from niche commentators. Instead, they see officials, central bankers, and mainstream economists speaking about risks. This development transforms perception. What was once labeled as unrealistic is becoming increasingly accepted as plausible. The practical outcome is a ripple effect across the global economy. As countries explore settlements outside the dollar, the financial markets adjust in anticipation, not after the fact. Investors reprice assets, foreign exchange traders adjust strategies, and multinational firms consider building new systems for payments. The buildup of these decisions amplifies the influence of each new agreement between states. In economic terms, expectations often drive reality. The moment enough participants believe the dollar is less unique, they change behaviors in ways that reinforce that belief. This is the loop currently underway, which explains why the media narrative accelerated. Part of the intensity in 2025 also owes to how this story intersects with broader economic pressures. With inflation stubborn in many regions and interest rates already high, households worry about affordability. Currency weakness compounds those fears. Policy decisions in Washington about deficits and borrowing get reinterpreted through the lens of whether global markets will continue financing them under the old assumptions. That extra scrutiny filters into coverage because it fuels political debates at home. If the US can no longer assume unlimited demand for its bonds, the domestic consequences become weightier. Journalists seize on those stakes because they generate both political drama and economic significance. The other amplifying factor is the way alternative blocs are structuring their financial arrangements. Groups of countries are consolidating their positions, making the choice to avoid the dollar less about symbolic resistance and more about establishing independent systems. Importantly, not every participant shares the same motivation. For some, it is about gaining protection in a turbulent world. For others, it is about expanding influence. The diversity of motives shows that this trend is not driven by a single actor pushing an agenda, but by a collection of different strategies all aligning on the same practical step: reducing reliance on the dollar. That alignment enhances credibility, which makes the story louder. In effect, the frequency of headlines is a measure of how far the conversation shifted away from theory. The more countries act on the subject, the more businesses adapt, and the more consumers feel side effects, the louder the story becomes. This is why in 2025 it crossed from economic background noise into mainstream awareness. The media is responding to tangible activity, and audiences are responding because outcomes affect their lives. The mini payoff here is simple: de-dollarization is no longer a niche topic. It is seeping into actual transactions, influencing market behavior, and showing up in everyday costs. When usually slow-moving discussions reach this scale of attention, it marks the beginning of a real economic current rather than a passing idea. And that current is what global markets are starting to navigate today, setting the stage for shifts that will define the coming years. In the coverage pattern, this moment feels like moving from a whisper to a conversation. Each fresh report signals that the protection the dollar once enjoyed as an unquestioned standard is giving way to a landscape where alternatives are multiplying. That recognition does not mean instant replacement, but it shows that primacy is being challenged in meaningful ways. Once a system accepts that alternatives are both possible and active, the stability that supported dollar dominance begins to weaken, even without dramatic events. This is why mainstream headlines across 2025 are louder, steadier, and more focused on the dollar's position than at any point in recent history. The shift is not just intellectual, it is embedded into actual economic flows, and that is what gives the story its weight. What remains most important is that the conversation itself reinforces the reality it describes. When journalists repeat, investors adjust, and policymakers respond, the idea that the dollar can decline becomes entrenched in public thinking. And that shift in mindset increases the likelihood of further practical steps away from dollar usage. In simple terms, 2025 marks the year when the discussion about currency dominance stopped belonging only to theorists and became part of the daily economic environment shaping choices across the globe. China's push. How the yuan is climbing the ladder. China has never hidden the fact that it wants the yuan to play a larger role in the global system. And in 2025, that ambition has become clearer through a mix of policy moves and trade arrangements. Where earlier efforts looked like tentative experiments, the past year has made it obvious that China views currency power as part of its long-term strategy. The yuan is no longer treated as a purely domestic tool. It is now being positioned as a competitor in trade, finance, and international reserves. Beijing has not declared it wants to dethrone the dollar outright, but the design of recent policies suggests that steady erosion of American currency primacy gives China leverage in negotiations, in diplomacy, and in economic influence. One of the clearest signals came from oil payments. Several major producers are now willing to receive yuan in exchange for crude exports, and China encourages this by offering liquid trade channels to settle the transactions. Energy trade has always been a key pillar underpinning the dollar's dominance, so the fact that suppliers agree to accept yuan represents more than just a symbolic gesture. These payments create precedents that normalize the yuan in sectors outside its home region. Once enough trade flows are settled in a currency, banks, traders, and governments begin to hold more of it to reduce exchange risk. That process slowly builds the infrastructure required for a reserve currency. China's oil deals demonstrate how targeted settlements in specific industries can boost a currency's global profile without requiring sudden, sweeping adoption. The expansion of BRICS adds a second dimension to this push. With new members, the bloc now commands a larger share of global trade and production. What matters most for the yuan is that these countries are either neutral toward American influence or actively looking for alternatives. The group's joint statements and projects highlight the need for financial systems that bypass the dollar. While not every member agrees on a single vision, the collective momentum works in China's favor. Its financial networks already underpin large parts of the bloc's transactions, and the adoption of yuan in cross-border settlements within BRICS shows how membership expansion amplifies China's reach. The symbolism of a major bloc supporting non-dollar trade translates into concrete flows whenever deals are arranged in yuan. Despite these advances, one persistent obstacle remains: China's own control over its capital markets. For all its external ambitions, Beijing still restricts the free movement of capital inside its borders. Global investors hesitate because they cannot easily move money in and out, and that constraint is critical when evaluating a reserve currency. Reserve status requires not just use in trade, but deep, open markets where the currency can be invested, borrowed, and hedged with confidence. China's refusal to liberalize fully keeps large-scale adoption at bay. Even allies or partners willing to trade in yuan often choose to convert surpluses into other holdings afterwards. This tension between external ambition and internal control illustrates the core barrier China faces. A currency cannot dominate if its issuer maintains walls that prevent smooth flow across borders. Yet visibility is often half the battle in financial systems, and the yuan's visibility has surged. Trade agreements repeatedly include provisions for currency settlements in yuan. Regional partners, especially in Asia, accept deals that previously ran exclusively through the dollar. Even in regions far from China, governments now weigh whether denominating part of their trade in yuan makes sense when negotiating with Beijing. Visibility matters because it habituates actors in the system. The more they see yuan being used, the more common it feels to accept. This growing presence signals progress regardless of whether capital markets remain partially closed. While the yuan is far behind the dollar in reserves, the fact that it routinely appears in trade flows establishes a foundation for future influence. What was once unthinkable, oil denominated in yuan or settlements in African resource projects, has now happened often enough that the market no longer treats it as unusual. China does not need rapid replacement of the dollar for its strategy to succeed. Gradual erosion of dominance suffices. Every transaction in yuan is one fewer in dollars, and every reserve shift away from the dollar reduces Washington's ability to dictate financial terms globally. Erosion strengthens China, even if the yuan does not attain top status. With steady gains, Beijing can negotiate trade, investment, and geopolitical decisions from a position of greater leverage. A full replacement might not even be China's realistic goal in the short term. Instead, creating multiple options diminishes America's exclusive power. In a system where dependence is spread out, influence becomes multipolar. This condition improves China's standing in disputes, in trade talks, and even in military tensions, since financial leverage underpins much of diplomacy. The mechanism through which China raises the yuan's profile is not only trade agreements or BRICS. Infrastructure lending provides another channel. Through projects funded by its state-controlled banks, China can require or encourage repayment in yuan. These flows cement the currency's presence in regions that otherwise would rarely touch it. As infrastructure loans mature, borrowers accumulate yuan balances, which then cycle back into trade. The system gradually locks participants into routines that strengthen the yuan's role. While repayment terms may look like normal financing, the added effect is a persistent presence of Chinese currency beyond its original market. When these practices spread across dozens of countries, familiarity with yuan transactions expands far more than through voluntary deals alone. China also pairs financial efforts with technological innovation. Payment systems that operate outside Western dominance give partners confidence that yuan settlements are reliable, even if American sanctions affect dollar-based systems. These payment networks reduce the risk that external political decisions could cut off flows. For countries wary of dependence on Western banks, Chinese alternatives look practical. Participants often emphasize that even if the yuan never replaces the dollar, having an electronic system to process trade in yuan secures them from being trapped. This technological layer builds infrastructure that consolidates China's currency ambition. The role of payments is less visible than reserves data, but it matters immensely because it underpins trust in daily transactions. China's strategy also exploits gaps created by American policies. When Washington imposes sanctions or demands compliance through dollar channels, targeted countries look for alternatives. Yuan use has grown most rapidly in places where sanctions make dollar access risky. This demonstrates how political actions accelerate shifts that economic logic alone might have taken decades to achieve. By being available as an alternative, the yuan transforms signs of resistance into practical adoption. Even small shifts produce headlines, and those headlines in turn normalize more use. America's enforcement power indirectly contributes to the yuan's visibility, since resistant countries must find a workable transaction tool, and China is ready to provide it. Still, adoption at scale requires more than strategic openings. Trust in the issuing government's predictability remains crucial. International investors remain cautious due to concerns about sudden changes in China's policies. Currency dominance relies on credibility, and credibility grows from decades of consistent practice. China's shorter track record creates doubts that slow progress. Countries may use yuan in specific trades, but hesitate to hold large reserves of it. This limitation keeps the dollar's share dominant. The barrier may persist until China demonstrates steadier transparency, which so far remains unlikely given its governance model. As a result, the yuan gains attention without capturing the depth of trust that underpins the dollar. Yet, these limitations do not negate the progress achieved. The yuan has shifted from being a regional currency to a tool with global reach. Its role in oil payments, infrastructure finance, BRICS trade, and sanctioned markets shows that China has successfully opened channels of regular use. While barriers prevent a giant leap into reserve dominance, incremental advances serve China perfectly. Each step erodes the sense of inevitability around the dollar. That erosion is precisely the leverage Beijing seeks. The path forward is less about overtaking and more about balancing. By balancing, China forces a redistribution of global influence that undermines the once exclusive privilege of the United States. When viewed in the context of the past few decades, the current position of the yuan looks remarkable. From near invisibility, it has achieved global presence in energy, infrastructure, and regional settlements. The gap with the dollar remains vast, but the perception of momentum is enough to influence decisions by governments and businesses alike. Momentum ensures that even without breakthrough liberalization, actors will continue to experiment with yuan transactions. Each experiment makes it harder for the world to imagine a dollar monopoly. That change in imagination is crucial because it sets the direction for policy, investment, and trade. The significance is not whether the yuan is ready to replace the dollar tomorrow. It is that the yuan has become an acknowledged pillar of the long game. China sustains its trajectory by concentrating on steady gains, by embedding its currency in sectors where influence is strategic, and by normalizing its use to the point where exclusion feels incomplete. In a system where every marginal shift matters, China has secured the advantage of persistence. That persistence transforms small flows into leverage. Where 2025 stands is not at the moment of replacement, but at the recognition that alternatives to dollar dominance are not speculative fiction. They are lived experiences, accumulating month by month, all tied to the steady climb of the yuan's reach. The 2025 Reserve Currency Breakdown. Looking at the most recent data from the IMF and World Bank, the dollar still commands the single largest share of official foreign exchange reserves, but the direction of the trend is not flattering. Central banks continue to hold a majority of their wealth in dollars, yet the percentage has fallen more quickly than anyone projected just a few years ago. When the last major forecast cycles were published, analysts assumed erosion would be slow, predictable, and modest. Instead, the last 3 years show movement that outpaced those expectations, creating a sense of uncertainty about the pace ahead. The dollar remains the anchor, but that anchor is no longer as heavy or immovable as it once seemed. To put this into context, looking back over the past 2 decades shows remarkable stability. For much of the early 2000s, global holdings of dollars in reserves hovered around levels that seemed permanent. The euro chipped away in places, and other currencies appeared in the margins, but the basic architecture never looked threatened. In those days, the dollar's share was nearer to 2/3 of total reserves across central banks. That share has since fallen into the upper half range, leaving a noticeable gap compared to the past. What looks like a few percentage points on a chart translates into hundreds of billions of dollars in actual reserves redirected elsewhere. Scale matters here, and losing even a sliver of market share represents significant shifts in global choices. It becomes more striking when you compare today with the last 3 years alone. From 2022 to 2025, the decline ran faster than the models projected. Analysts who anticipated a gradual reduction over a decade now admit the trajectory compressed. Even with expected rebounds here and there, the underlying slope demonstrates persistent slippage. That slippage is not catastrophic, but it is visible, and visibility is what grabs attention among policymakers, businesses, and markets. Numbers do not have to collapse to signal a problem. They only have to trend in the wrong direction at a quicker clip than anticipated. Once that happens, conversations about urgency begin, and those conversations feed into headlines around the world. The dollar continues to enjoy inherent advantages that alternative currencies lack. It represents the deepest financial markets, still highly liquid, with unparalleled accessibility for investors. But dominance works best when it looks unquestionable. What has shifted is that the element of certainty has been replaced with a growing recognition that alternatives are gathering strength, even if collectively rather than individually. The yuan, the euro, and to some extent other regional currencies carve out modest shares, and each gain adds to the cumulative effect. The dollar remains center stage, but you could think of it as a television reality show. It is still the lead character, with the storyline revolving around it, but episodes now give more screen time to side characters. That reduced exclusivity captures the idea that the star is still the star, yet the narrative no longer belongs entirely to it. This shift carries psychological weight. Central banks allocate reserves with long horizons in mind. Sudden changes are rare, gradual repositioning is more typical. When multiple institutions independently recalibrate their allocations over just a few years, that indicates a broader reassessment of trust, not a coincidence. Policies in Washington, especially fiscal choices and debt ratios, influence how reserve managers think about risk. They do not necessarily panic, but they account for the possibility that exposure to the dollar could bring higher volatility than before. placements into other currencies provide a hedge. Collectively, those hedges add up, and the data shown by the IMF captures that accumulation. The more visible those reallocations become, the more confidence other central banks gain in doing the same. It forms a reinforcing loop. Historically, the slow-changing nature of reserve distributions meant that any shifts were expected to unfold over decades. That remains broadly true, but the fact the decline is faster than earlier models predicted introduces doubt about how long the dollar can expect to sustain its extraordinary share. Each report fuels arguments that the turning point is sooner than previously thought. Analysts who once dismissed the subject outright now describe erosion as genuine, if not yet monumental. Overshoot in predictions is common, but what is new is the realization that the dollar is not immune from accelerated rebalancing. The slope on the chart hints at potential momentum. Momentum is often more significant than the level itself, because it shapes expectations of the future. Reserves data also reveal where the pieces of market share are going. The euro continues to hold a notable portion, a legacy of Europe's large economy and established bond market. The Japanese yen and British pound remain traditional components, though their shares have barely shifted in relative terms. The yuan, however, while still smaller in comparison, has logged steady growth. What matters most is not the absolute size, but the trajectory. Consistent gains, even from a small base, suggest momentum that may compound in coming years. This reinforces the sense that the system is moving from unipolar dependence on the dollar toward a more diversified structure, where multiple currencies share influence. That diversification indicates insurance against American fiscal or policy shocks. Yet even as the numbers show slippage, the dollar retains crucial dominance. Its network effects are formidable. Most global trade invoices remain denominated in dollars, and the habit of using it across markets creates inertia. Central banks still see it as the primary refuge in times of crisis. Its deep treasury market serves as collateral across the global financial system. Without these advantages, the pace of decline might look sharper. But with them, erosion remains measured, not catastrophic. Investors recognize that carelessness in American policy could accelerate diversification, but stability and liquidity still tether the dollar's role. That tether keeps the erosion from spiraling downward quickly, even if smaller drains continue year after year. A reality check is important. The dollar does not face elimination as a reserve currency. What it faces is gradual adaptation to a world where alternatives are treated with more seriousness. Losing a few percentage points over 3 years may not look disruptive at first glance, yet the meaning lies in comparison with past decades of remarkable stability.